quarterly information webinar for our stakeholders. And today we're joined by Brian Garcia, our President and CEO, who will be leading us through the presentation, and I'll also be joining in throughout to give an update on the residential sector. Just a few housekeeping items. We are recording the webinar, and the presentation and the recording will be made available. We'll send an e-blast out when that's ready. And then for those of you who have questions, I'm sure we will have folks who want to ask questions. Please enter your questions into the question box. We'll be monitoring those throughout, and we'll be doing questions at the end. We will monitor, and if there are any we need to address as we're going through the presentation, we'll take those as well. So with that, I'm going to turn it over to Brian Garcia.
All right, great. Good morning, everyone. Carrie, looking forward to joining you this morning on this presentation. Let's go ahead and go to the next slide. So what we thought we would cover today is start off with just working through our different sectors and going through sector updates. And then we're going to wrap up the presentation today on just kind of a 2014 year in review, some of the big highlights that happened in 2014. All right, back one slide. Sorry. Go ahead and go back one more. Oh, okay, I guess it's out. Okay, go forward. One more. All right, great. So we're going to start off with the statutory and infrastructure sector program, and this is a bit different, but we're going to start off with the Colebrook Wind Project. For those of you who don't know, back about 5 years ago, the Connecticut Clean Energy Fund provided a $500,000 pre-development loan to BNE Energy to look at several several wind sites in the state of Connecticut. We have just recently are moving forward on financing a 5-megawatt project in Colebrook Wind. We're excited by this project, about a $25 million wind project. Again, this will be the first utility-scale wind project in the state of Connecticut outside of the 100 kW unit in New Haven. This is a Section 127 project, so Eversource Energy will be engaging in a long-term contract for the energy as well as the renewable energy credits. And we're working with closely with Clean Energy and our other private capital partners to bring all the investment to the table, and we've got all those pieces put together. So we're excited to see a local Connecticut-based regional bank coming into the project and providing construction and senior debt into the structure. So again, great to see diversity of projects going into Connecticut, and this is a grid-tied system. Next slide. So we wanted to do some catch-up on where we are looking at behind-the-meter distributed generation here. So the residential solar investment program, where are we to date? So over $250 million of investment. So we've almost reached 60 megawatts of approved projects. So for those of you who know, that will be double our legislative target, which we have a 30-megawatt target by 2022. So we will have doubled that target 8 years ahead of schedule. We're seeing dramatic results in this market. Installed costs have come down by over 20%. Incentives have been reduced by 60%. The incentive level currently in Step 6 is equivalent to a $40 ZREC price. So just to give those of you on the line who are familiar with the ZREC, an equivalent price. All the while, we've been able to, working with the solar industry, increase demand for solar by 2,000% since 2011. So everything moving in the right direction. Carrie, Bert, and the team have been working very hard to attract more private capital into this market. So we've got over $175 million in lease loan financing, and we're going to talk about how those programs are doing in a second. Over 8,000 projects. This is roughly 4 times what the Clean Energy Fund did in 8 years. So we're seeing dramatic results here. And of course, all of this ends with more jobs and more greenhouse gas emissions being reduced. So you all seen this slide from time to time. I think there's going to be a couple of things I want to focus on. So this is through January of 2015. So if you look at the 2015 numbers, in 1 month we've approved roughly 6 megawatts of rooftop residential solar PV. That's quite a bit. So you see the extension of the dotted line up top. Are we looking at a 50-plus megawatt year? Again, we're seeing dramatic growth in this space. Go ahead and hit the button. A couple of other things I just wanted to point out is, installed costs appear to be leveling out a bit, although we're diving further into this data to understand it a bit. But if you look at the overall average installed cost for all installations in the program, they're roughly flat. But again, we're going to be diving into this a little bit because we think there are going to be some differences for home ownership versus lease PPA model pricing. Go ahead and hit the button one more time. All the while, you can see there the gradual decline in incentives. So the blue bar there represents the incentive level on a dollar per watt basis for rooftop solar PV in Connecticut. And we're currently, I just took a look at the numbers today, we're at about 50 cents per watt for rooftop solar PV, down from $1.75 per watt 2.5 years ago. So again, great to see that. Next slide. So one of the things that we're just starting to look at as we think about what's likely to happen in the future following the ITC at the end of 2016, no one knows where that's going to end up, but we just want to see where solar PV might stack up. So we're starting to look at levelized costs of energy from a homeowner's perspective, which is what's a per unit price for kilowatt hours coming from a solar PV system. So, as you look at the installed costs, again, we're going to continue to work hard with the industry to reduce installed costs. If you look at the various scenarios, given the residential solar investment program and what step you reside into, whether or not the ITC exists, at the end of the day, what's the per kilowatt hour cost to the homeowner? We've also embedded in this cost financing costs. I believe we use a 15-year 6.49% interest rate, so all of that is embedded in this pricing. And what you can see is that for the most part, across the board, no matter what scenario, the levelized cost to the homeowner is less than the current utility rates for customers. Again, we're going to be working hard to continue to drive those costs down. Go ahead and hit the button. If you look at solarized pricing, for example, again, at $3.75 per watt, what you see here is really strong levelized cost of energy data given any future scenario. So again, a good message, which at the end of the day, again, focusing on reducing installed costs will be one area that we'll continue to address while also providing consumers with easy access to long-term, low-cost capital. And at the end of the day, what we're trying to do is to deliver competitive utility rate pricing from the perspective of what that solar PV system is producing. So again, we're just dabbling here, starting to understand this a little bit more as 2016 is ahead of us, or the end of 2016 is ahead of us. We want to be prepared for all of that transition. And again, on the installed costs, we're focusing a lot of our activity on reducing soft costs. So the industry is doing very well working with municipalities. And our Sunshot initiative, we just published the permitting guide last year. And our team is working out and about in communities across the state, and towns are starting to standardize their permitting process, and that's great to see. Also, on the customer acquisition side, you're all familiar with our Solarize campaigns. They're doing very well. We've got a partnership with Yale University, Smart Power, and a number of communities across the state. But some of the exciting things that Carrie and the team have been working on is how to expand that model. So we're actually piloting a program called Solarize U. We've got 6 universities, colleges and universities who have strong sustainability missions here in the state of Connecticut, and we're trying to see if the Solarize model can be applied to the employees of those universities. Think of it as staff, faculty, potentially even parents of students who live and reside in the state of Connecticut. We're building out this Solarize U pilot to see if the Solarize campaign can work in those communities. But what's exciting by this is that we're actually using a back-end online platform with our partner Energy Sage, and Carrie and the team have been working on it. And Carrie, maybe you want to speak to some of that.
Yeah, the idea behind partnering up with someone like Energy Sage is they offer a terrific, really rich, robust platform for running online campaigns for solar, and we've adapted it for this Solarize model online for Solarize U, and we're also testing it in 4 communities. And the idea here is really to understand our theory is that acquisition costs will be reduced by driving acquisition online and making it easy for folks to learn about solar and go solar. And early indications are that the numbers are strong. It's early days, so it's the green bank. We love to test things and run a lot of analysis and see if it's going to work. But as Brian said, this is all a way to help guide the industry in finding models that will reduce soft costs. And so we'll report back at the end of those campaigns, or maybe more midstream, to see how they're doing. So I think that's actually a great segue into something that we just did recently and released to the market. We had a webinar, I think, 2 weeks ago on this. Again, along these lines of driving soft cost customer acquisition. We know that solar is a very expensive proposition in terms of installers acquiring customers. So one of the things we wanted to do to help the Connecticut market overall was to dive into what the customer segmentation profile is of the current customer in Connecticut going solar. Really excited to do this work with our agency using Nielsen Prism profiles. They're the gold standard of customer segmentation data. So you can go to that URL there. You can get really rich data on the 3 customer segments. There were some surprises in our customer segments. We have a unique segment in Connecticut that doesn't exist elsewhere in the country. We call them prudent Yankees. We also have a segment that is not going solar in Connecticut but is going solar nationally. So those are great prospects. So really encourage you to check out that data. If you are a marketer, you're an installer, a financier, very, very detailed demographic, psychographic, behavioral, geographic data, as well as insights on how to message and visuals to use, heat maps, things like that. And so if you have any thoughts on how we should be using that data or how you'd like to partner, please contact us. When you go to that website, you'll see a URL or an email to get in touch with us on that. So next up, I think we're just going to take a little bit of time to dive into the residential sector this quarter. We haven't reported deeply in a while. So I think we're very pleased with our progress to date. If you look at the products that we launched in 2013, so we're now 1.5 years, 2 years in on some of these products. So as we look at reporting through the end of the year, end of 2014, we've had over 2,500 applications across our 4 products. We've had really great approval rates from a credit quality perspective, and the early performance is excellent. It is early, obviously, from the financial performance side. Nearly $38 million in approved and enclosed projects. So really excited about that momentum, and that momentum has really come on strong in the last half of 2014. We have over 200 contractors eligible to offer our financing products, but our top 10 contractors do represent 60% of our applications today. So here's where we see contractors really taking to these financing products and growing their business and bringing a lot of repeat business to the products. Other highlight is, we have 16 capital providers who support us in these 4 different products. So let's talk about the lease first, CT Solar Lease. If you want to go forward one more there, Andrea. So we had very, very strong momentum in the, go back to the lease. Sorry, there we go. We had very, very strong momentum in the last half of the 2014, and we continue to see that momentum growing. So we have over $26 million in approved and closed lease transactions for the year, for the program to date. One of the things that we're seeing for the lease is that the pricing is very strong. Step 6 came into the market on January 1st, and we didn't adjust the pricing in the lease, so it's a really, really compelling offer for customers. We are coming into the final stages of our lease fund. It was designed to be a 2-year fund when we raised it in 2013. So we are coming into the final stages, and for those installers who are engaged with that product, we're going to be messaging out to you as we come into the final months of that fund. One note on the withdrawn rate, it is relatively high relative to our other products, and just a note on that, it's very, very easy to apply for this product without engaging a contractor. So what we do see is a lot of customers who aren't who aren't very far along the solar decision process when they apply for the lease. So we do see a lot of dropout, whereas in some of our other financing products or across the industry, you might not see that because the contractor's been engaged at the beginning before someone applies. So that is something that's unique to this product. Let's talk about the loan next. And I'm going to go through one more. There we go, one more. The big story on CT Solar Loan is, first of all, our provider here, SunGage, is our first loan product and our first provider to graduate off of the Green Bank balance sheet. And we're really excited to see that happen. So we did take our last application through CT Solar Loan on October 31st. And all told, by the time we run through what's in the pipeline, we will have originated about $6.5 to $7 million in loans. And the exciting news here is that as SunGage secured a new partner, they were able to secure better terms for customers because now they'll have a lot more flexibility. They can do both 10 and 20-year terms, where with us the product was 15-year terms only. We go to the next page, just talking about the journey of the CT Solar Loan product. You know, we started out supporting SunGage with a loan loss reserve, and then we provided a warehouse to originate the loans. And then, you know, kind of first model to do this went out to crowdfund selling off the loans to the crowd using the Mosaic platform, which is really exciting. You know, first to do that, we were very proud to partner that model. And it really shows that, you know, retail investors, individual homeowners want to invest in these products. And then the next phase was that SunGage went out and secured a $100 million commitment from Digital Federal Credit Union to basically offer the same product on better terms without the Green Bank. Again, really, really great to see this sort of evolution in the industry. We're really proud of the work we did with SunGage and proud of them. And it's great for us to see our products kind of graduating off and not needing our support anymore in the private sector picking this up. It's great for consumers. All right. Switching gears, let's talk a little bit about Smarty. Smarty has had its biggest 2 quarters in the last half of 2014 to date. And Smarty, recall, this is the loan product that we offer through credit unions and community banks. And you can pretty much finance anything, energy efficiency, natural gas conversions, renewables. So some of the big stories here is, you know, one of the things we're really proud of is the number of contractors that have submitted projects. It's up from about 65 or 70 in September to now nearly 96 contractors who are submitting projects. Really great to see such a diversity of contractors engaging with the products and making great offers to their customers. The other thing, just, you know, from 2013 to 2014, we went from $1 million in approved and closed loans in 2013 to we did $4 million in 2014. So right now we're sitting at about $5 million approved and closed loans. Next up, one of the things that we think is really interesting about Smarty is to see what's hot. I mean, we're clearly seeing a lot of heating and cooling, efficient boilers and furnaces and water heaters getting done. But the other thing that's really great for us to see is that almost a third of our projects have 2 or more measures, and this is up from 1 in 5. 1 in 5 in September. And this is really driven by the bundles. And so what we're seeing in the bundle offer is this is where you can get a 2.99% interest rate or lower on the 10-year loan if you're doing more than one eligible bundle. So what's hot in the bundles is Solar Plus. Solar plus heat pumps, solar plus insulation, and then we also see kind of multiple HVACs as most popular. But the other interesting thing we're seeing is that, you know, some of this multi-measure work is not coming through the bundles. People are just doing more, so that's great to see. Last thing, we inspect all the jobs here, and we are seeing great quality work being done. Really, really pleased to see the level of work being done in homes. Just in talking about the lenders and driving competition in the market, we have 9 community banks and credit unions in the program, and we are seeing that, you know, this idea that lenders would start to compete for business is actually happening in the market. So we've got 8 lenders who participate in our bundle. We have 4 lenders who come down from our not to exceed rates and offer lower rates. In fact, our last 2 lenders who came in, Workers and First National Bank of Suffield, kind of across the board have lowered their rates. Very exciting to see. We've got 2 lenders who saw such an opportunity in solar in the bundle that they raised their loan limits up to $40,000. And then we have 5 lenders who are willing to go out to 12 years. On an unsecured loan, that's a really big deal. So we're really pleased to see this sort of competition being driven among lenders.
Hey, Carrie, one question to break in on these loan products. A question about what costs and fees can be capitalized into these products. Can contractor fees and costs be capitalized, and also if a borrower retains a paid third-party agent, can the cost and fees charged by this third-party agent be rolled?
So this is Maggie Dykes talking, our COO. Thank you, Maggie, for asking those questions. So these are homeowner-oriented products. So in terms of fees, yeah, I mean, if you're working with your installer and you've got permitting fees or other sort of fees that are related to the energy project being done, absolutely, that can be incorporated into the Smarty loan. That can be incorporated into the solar loan products. If it's a third-party consultant and a homeowner, I think on that, I'm like, give me more information about that, contact us about that, because I'm not quite certain how that would work in a homeowner. That sounds more like a business scenario, and these are homeowner-oriented products. So I don't know about that one. So have them follow up. My contact information will be at the end. So the other thing, just quickly on the Smarty loan side, in terms of the credit worthiness of the portfolio, this is super important to our 9 credit unions and community banks, and very, very strong credit statistics in this portfolio, very high FICOs, low DTIs. About 10%, 11% of our loans are in that lower FICO band, 640 to 679. No delinquencies or defaults to date. Early days again, let's jump the gun and think it's always going to be like that. And always interesting for us to look at the distribution of loan terms in the Smarty product. It is interesting to us to see, we still see a very high proportion of our loans in that 5-year loan product. If folks can afford the loan payment, they want to do it as quickly as possible. You see the 10-year loan coming on strong, as well as the bundle loan coming on strong. That's really starting to grow as a percentage. We do buy down the first 6 months of loans, or if you're doing the bundle, we buy down the rate to $299. It is expensive. Those are our costs there, but worth it to serve this market. And then just briefly on the multi-sector side, multifamily side, this is a very, very challenging market. This is a place that we've been spending a lot of time over the last 18 months. We're taking a partnership approach. We're working closely with CHAFA and the Connecticut Department of Housing, the MacArthur Foundation, CDFI such as Connecticut Housing Investment Fund. So very much a partnership approach with a portfolio of programs. Owners can get technical assistance to really help them figure out what to do and what financing and rebates they should be thinking about, and using monitoring tools. So in terms of the financing options, we have CPACE for multifamily. We have the Lime loan to the Connecticut Housing Investment Fund. We also have an open RFP for credit enhancements that could be used for pre-development gap financing. Really, if anyone's got any questions or potential projects here, call Kim or email Kim Stevenson. She runs our multifamily programs, and she's available to help you. I think our message here is we're open for business. It's a hard sector. We're working across market rate and affordable. We want to work with you to figure it out. And then last, very quickly, a plug for some low-income market analysis that we recently finished up. Our board asked us to take a look at the residential market and low-income in particular, and how we can better serve them. So we did some comprehensive analysis of the low-income housing market. 30% of our low-income residents live in single-family owner-occupied homes. That was a surprise to us. About 40% live in small rental units. And then only 15% live in what we might traditionally think of for low-income housing. So we have a draft strategy recommendation. We're doing a lot of work on this. There are 2 links there to our draft strategy and market analysis. Anyone has any questions on that, please contact me about that. And with that, that's the wrap-up of residential. I'll turn it back over to Brian.
Great, Carrie. Great. Thank you for that overview. That was great. So now we're going to jump into how we're doing on the commercial and industrial space, and we're going to provide an update on where CPACE is. So 105 cities and towns have opted into the program, which is extraordinary. We just actually launched CPACE 2 years ago, so to see 105 cities and towns opt in over a 2-year period is incredible. Over 85% of the commercial and industrial market now has CPACE available to them to help finance their energy improvements. We've got over 100 companies trained on CPACE financing, 34 of which have approved projects. We've seen 25 mortgage lenders providing consent. Again, this is very, very important. This is a requirement per our CPACE statute that we get the existing mortgage lenders' consent. And just recently, as of the end of last year, we now have over $70 million in CPACE deals approved, including the first fuel cell project. So if you're out there developing fuel cells, you should look at CPACE as a way to provide long-term, low-cost financing to get those projects going and to better compete in the LREC auction. These projects will deploy over 10 megawatts of renewable energy, and what we're seeing is that CPACE is enabling property owners to save between 30 to 40%. So those projects that are pursuing energy efficiency are going deeper on energy efficiency savings. And lastly, we'll talk a little bit about this, is that, of course, last year we sold $30 million of our CPACE transactions. We used our Regional Greenhouse Gas Initiative proceeds to help provide funding to a warehouse to source these deals. And we're currently actually wrapping up a process. The market in CPACE is growing very rapidly. In fact, we had established an annual target in our fiscal year of $50 million worth of transactions. In the first 6 months of CPACE, we're actually at $50 million worth of transactions having been approved. So this, of course, from our mindset, then requires us to go out to the markets and see if we can raise somewhere between $50 to $100 million of private funding to support CPACE on an ongoing basis. And we have just recently closed an RFP where we've received a number of proposals from private capital providers interested in this market. But what we're also doing, we have also learned quite a bit on CPACE. You might all recall that when the CPACE legislation passed, we immediately opened the market. We tried to establish a lending tree model, which was to say to the market that Connecticut is open for business when it comes to CPACE financing. We didn't see lenders rushing to the table to originate transactions. We had a number of private capital providers that were qualified to come in and provide CPACE financing, but we didn't see them on the ground in our communities working with building owners to get projects originated. So that's why we took on the task ourselves of developing a warehouse and getting the market moving and catalyzing the market. Well, we're now going back and seeing if we can further open up the market, so we've issued a standard offer. There's a link here. Go ahead and hit the next. So what we're trying to do here is to expand access to private capital originators and financiers. Again, we want Connecticut to be an open market for private investment in CPACE. Perhaps as a result of the success we've achieved, we'll see more private activity originating and financing CPACE transactions. So what you'll see on the CPACE website is a draft term sheet. And for those of you who are interested in being a standard offer provider of CPACE financing, definitely visit the CPACE website at cpace.com in the About Us section, and we'd be happy to have conversations with you to invest in Connecticut. Next slide. So, you know, we've got a number of projects that we've been highlighting through our PaceSetter campaign, and what you're looking at is just a number of these different PaceSetters. But you can imagine all these transactions we've been originating since the start of the CPACE program. We've created a standardized set of documentation. We've worked with the private capital industry to develop this sort of documentation. And as a result, we're packaging all these CPACE benefit assessments into this warehouse that I mentioned before. So we've been originating loans or transactions, CPACE transactions, and what we've been able to do is then sell those transactions off into the private market so that we recover our funds. So last year we were able to issue $30 million of privately placed bonds, of which 80% was taken by Clean Fund, and we currently sit on Series C and Series B bonds for 20% of that portfolio. But this ended up becoming what was the first securitization of commercial efficiency loans. The team is very excited by that, and what we're hearing, and Terry and Bert and the teams are out at various events, is that a lot more investors are now attracted to this market. So we expect to see more investment not only in Connecticut but across the country as a result of this transaction. So I just wanted to end the C&I section with this viewpoint for folks who are online and interested in CPACE from the perspective of behind-the-meter ZREC, LREC projects. So we just pulled some data. And again, this is preliminary data. There aren't a significant amount of data points, but what you're looking at here are ZREC projects for the medium and large projects. These are projects that have to compete in the reverse auction. And for those projects that use CPACE financing in the medium and large auctions, what you can see is that in the medium auctions, they are requesting a ZREC price that's 20% less than the average. So CPACE is enabling these projects to better compete and win those ZREC prices. And for the large projects, you see about a 10% price reduction. So for all of you who are out there who want to compete for these ZREC projects, you should take a look at CPACE. Again, the long-term low-interest financing rate will make your ZREC price request much more competitive. We've even seen some projects come in recently that have yet to receive a ZREC contract but are utilizing CPACE and enabling the projects to move forward in light of that. One of the challenges that we've put out there, and we want to continue to get out there, is how CPACE can be used to finance fuel cell projects and better compete, help project developers better compete in the LREC competition. So we just finally approved our first fuel cell project with Doosan. We're excited by that, and we'd be happy to speak further with folks who are listening in on how CPACE can help you better compete in the LREC auction. So again, takeaway here is CPACE plus ZREC, LREC can in fact make you more competitive in those auctions. So we're going to move now to our last sector.
One question before we move away from commercial and industrial. We had clarification on the question about third-party agent costs being rolled into the loans, and it is a C&I project. I just want to let the questioner and everyone know that yes, the third-party agent cost can be included in a CPACE loan as long as the savings to investment ratio remains above 1, which is a statutory requirement.
Great, thank you. Thanks for bringing that question back. So on the institutional side, so our last sector is really supporting activities in the state, municipal, university, schools, hospital market. And on our progress to date, so big picture, we have been working with our colleagues in the state, the Department of Energy and Environmental Protection, Office of Policy and Management, Office of the Treasurer, Attorney General, to really try to finalize a private capital mechanism. This is a master lease agreement. We're very close to having that completed. This will enable private capital to come into the market and complement existing available resources from bond funds that would come from the state. We also, our board recently approved of a working capital loan facility that will support some of the projects at their early stage development. So this will enable us to build a pipeline of projects that down the road would enable the performance contracts to be done through the qualified ESCOs for the program. And just lastly, just wrapping up this section, we do offer the performance contracting program through our colleagues at DEEP for municipalities that want to undertake performance contracting. Again, our team, our state team provides great technical support. So if you want that, just let us know. And we've revised some of our Clean Energy Communities points programs to support your activities and efforts and reward you for undertaking performance contracts to save on your energy costs. So we're just going to wrap up here, which is what happened in 2014. So a 2014 review. So we started off the year saying farewell to Commissioner Esty, who went back to Yale. We hosted an event with the Yale School of Management and the Yale Center for Business and the Environment. You can see here Commissioner Catherine Smith, Commissioner Esty, and Richard Kaufman, who's very actively involved in New York's efforts, and Reed Hunt, who's on our board, Alfred Griffin, who's the president of the New York Green Bank. It was a great evening of celebrating what's happening across the country on the Green Bank movement, and was a way to say farewell to Commissioner Esty, who's been so instrumental in a lot of the activities that we've been doing. And so in light of that, we welcomed Commissioner Rob Klee to join the board. Everyone knows the Commissioner of DEEP, and Commissioner Klee is also the chair of the Budget and Operations Committee of the organization. We co-hosted with the Brookings Institution and the Coalition for Green Capital a Green Bank Academy back in February of last year. One of the activities that resulted from that was the release of a federal the Green Bank Act of 2014 by Representative Van Hollen, Representative Esty and Himes, and Senators Blumenthal and Murphy on the Senate side. Again, this is a bill that was proposed. Nothing's been acted on, but a lot of the basis of the bill comes from the Connecticut Green Bank model, so we're excited to see that. The staff was very, very excited to see President Obama in California speaking about clean energy. Here he is at a Walmart store, and one of the quotes from his speech that actually occurred several days after the Connecticut legislature passed the renaming of the Clean Energy Finance and Investment Authority to the Connecticut Green Bank. So President Obama stated in his remarks that we've got public banks like Connecticut's Green Bank and private banks like Goldman Sachs ready to invest billions of dollars in renewable energy. Our staff was very, very excited, obviously, to see this, and it's great to see Connecticut out there in the federal world amongst conversations on the role of government in attracting private investment. We also added Kevin Walsh to our board of directors. For those of you who are in the energy finance space, you'll know that Kevin is amongst the leaders in this space. So he's very actively involved in GE's Energy Financial Services Division in Stamford, and we're excited to have Kevin on board as a board member. We saw the EPA Administrator Gina McCarthy coming back to Connecticut. Here she is at the Bridgeport Fuel Cell Energy Project. She was very excited to come back and talk about the EPA plans on carbon emissions while also supporting clean energy production. You can see Representative Himes here, Commissioner Klee, Mayor Finch, and a number of other guests. And in typical Gina fashion about this device, she says this is wicked cool. So for those of you who know Administrator McCarthy, you would easily be able to associate her saying something like that about this project. So very excited to see her come back to Connecticut and be at one of our important projects. We saw Governor Christie this year join the Green Bank movement with the launch of the New Jersey Energy Resilience Bank in the fall. Alfred and myself have been very actively involved in reaching out and working with Mitch in New Jersey as they get the New Jersey Energy Resilience Bank up and running. It's exciting to see them on board. We had an International Green Bank Summit in Bloomberg. We were co-leading a panel with the UK, Australia, Japan on the emergence of green banks. It was exciting to be a part of that summit, but at the end of the day, all of us collectively who were involved will be deploying over $15 billion in capital while attracting another $25 to $30 billion of private investment over the next 5 years. So a lot of activity happening on the Green Bank front. And just kind of wrapping up here, so we've now kind of worked ourselves through the first 3 years of the Connecticut Green Bank. We actually just finally approved our first comprehensive annual financial report. So in the follow-up to this webinar, we'll be sure to get you this CAFR, we call it. It's very, very comprehensive. But in comparing what the Connecticut Green Bank did, there aren't very many benchmarks out in the market. Green banks are very new. But what we did is we took a look at the prior decade of our predecessor, the Clean Energy Fund, and started to ask ourselves, what are we doing differently and what are the results that we're seeing? So you can see here that we're deploying clean energy at a faster pace while also using the ratepayer resources in a much different way. So 60% of the resources that we've utilized over the first 3 years of our organization have been used as loans. So that's a big, big transition from what was 10% before. So this movement away from subsidies and towards financing is yielding results. But one of the things I wanted to share with you is that if you look at our year-to-date fiscal year, Q1 and Q2, this is 6 months worth of data. In 6 months, we have approved the same amount of clean energy projects as was done in the decade from the Clean Energy Fund. So just to give you some context, that's pretty extraordinary. 6 months, 43 megawatts, 11 years, 43 megawatts through the Clean Energy Fund. This is the strength of the Green Bank model. You know, we're 6 months in, we're already at $250 million of projects approved. Who knows, we have an outside shot at $500 million of total investment in clean energy in 1 year. Again, really speaking to how the Green Bank model is changing the equation here by attracting more private investment and allowing us to deploy more clean energy at a faster rate. And then lastly, just wanted to wrap up with what are our kind of legislative issues for this 2015 year. We talked a little bit about the residential solar investment program. So we've nearly doubled the legislative target 8 years ahead of schedule. And we're currently working on a policy design to support a sustainable solar PV market that lowers the RPS policy costs while also creating jobs in Connecticut and contributing to the economy. So we suspect that the legislature is very interested in our views on how the state might evolve its policy on rooftop solar PV. We were also asked last year to conduct a study on residential property assessed clean energy. So we just recently delivered an RPACE study to the Energy and Technology Committee, and we'll make that study available to everyone on this webinar when we do a follow-up. And the study is really recommending that Connecticut, in fact, develop and enact a policy while addressing the federal concerns. So take a look at that. We'll put that in the materials as a follow-up. And then we have a few CPACE technical fixes, again, that will help us drive more towards attracting more private investment in Connecticut to get more clean energy deployed. So those are our 3 items that we're really focused on this legislative session. And I think with that, that is our update. And we'd be happy to take any final questions, comments.
Yeah, we had a question about, Carrie, you could speak to options for public housing?
Sure, in the multifamily sector. So there's no one answer there. We have a range of ways that we can work with public housing authorities, and we're going to typically do this in conjunction with some of our other partners. We're working with the Department of Housing and CHAPA where it makes sense. They have CHAMP funding and critical needs funding available. So we'd look at it holistically. So I think the answer, and we also, we have one housing authority who's working with us on a pre-development fund that will then also leverage CHAM funding. So reach out to Kim Stevenson or myself. We can get you connected. We can start the conversation. There are a range of ways that we can support you. We can also support you with technical assistance, with benchmarking, just to get things going.
Great. Got a question about our claim of offering low-cost capital. And is that at odds with the fact that in some instances we're charging over 6% interest?
I'll address it on the residential side. Our loans are unsecured loans. So if you look at like if you went into your local bank and asked for a personal loan, which is an unsecured loan, you're looking at rates in the 9 to 14% range. So when you look at unsecured financing, our rates on the Smarty side, they range from 4.99 to 699 CG Solar line was at 6.49% for 15 years. Those are very, very, very competitive rates for unsecured lending. Now, if you want to refi your home and incorporate energy improvements into it, can you get a lower rate or do home equity? Absolutely. We're not saying we're competing with home equity or mortgage rates, but if you're looking for an unsecured loan because you're not ready to refi or tap into home equity, these are very, very competitive options on the resi side.
And to become the answer as well as the question here for a second, we focus not so much on interest rates, but on putting together financing that'll make a project cash flow positive to both businesses and homeowners. So, we do a lot and build our programs with that perspective in mind.
That's absolutely right. And so when you look at something like Smarty that has 5 to 12-year terms available at different rates, the reason we want to push more lenders out to 10 and 12 years is so that a homeowner has an option to do a deeper project that might need a longer payback but still be cash flow positive and be able to put money in their pocket right off the bat.
And on the C&I side, it is the strength of going longer that what we're seeing in the CPACE program is 75% of projects have received upfront financing for all those projects, and 75% of them are immediately cash flow positive. So the debt service payment on the benefit assessment is less than the energy savings that they're receiving from the energy improvement. So we're very focused on delivering that immediate positive cash flow to the property.
And in a lot of cases, we are offering loans below 6%. In CPACE, you're looking at 5 to 6%. Smarty, a lot of options below that as well. So a little bit of both. Okay, no other outstanding questions. We'll give folks one other minute on the phone to type in if you have any other questions. Okay, no other questions.
All right, so why don't we wrap this up? Thank you all for spending your morning with us here today. We will look forward to, in our next quarter, coming back to you and